Good morning. The mortgage rule that banks don't explain to borrowers. And most borrowers assume mortgage approval is simple. And they think the bank checks their credit scores, verifies their income, and then stamps the loan approved. But inside mortgage underwriting, there's a hidden rule most borrowers never really fully understand. And it can determine whether your deal gets approved or declined. So let's talk about it. And that rule revolves around your debt to income, DTI, your cash reserves, and your underwriting risk logic. And understanding how these factors work together can dramatically increase your chances of getting approved. And as a mortgage broker, my job is not just to quote interest rates, but it's to structure loans that actually pass through underwriting. And let's break down how this actually works. So, the first rule of mortgage approval is look at your debt to income ratio. And the most important numbers the underwriters will analyze is your DTI or your debt to income ratio. And DTI measures how much of your monthly income goes toward your debt payments. So what does that include? Well, that's your mortgage payment, principal, interest, taxes, insurance, everything of your costs. Any car loans, credit cards, student loans, personal loans, or any other installment debt you may have. And most conventional mortgage guidelines fall within these ranges right here. And 36% is an ideal borrower profile. 43% is about the middle of the road, and 45 to 50 is possible with compensating factors. And if your debt to income ratio is too high, underwriters assume that you, as the borrower, may struggle to make your payments. And that's why many loans get declined even when borrowers have strong income and credit. Just how much of your budget are you using? The second rule is cash reserves. Another major factor most borrowers overlook is reserves. And reserves represent how many months of mortgage payments you have saved after closing. So, for example, say you have 2 months of reserves, and that's basically 2 months of your mortgage payments and savings. But 6 months is a good benchmark, 6 months or more of your mortgage payments. So, six times, say, three, it's $18,000. But why lenders care about reserves? Mortgage investors want to know that borrowers can continue making payments, even if income temporarily drops. And higher reserves means that you can offset a higher debt to income ratio that way, but also strengthens weaker credit profiles and helps approvals for investment properties and reduces your perceived lender risk. And many borrowers qualify for loans specifically because they have strong reserves. The third rule that underwriters evaluate is risk, not just numbers. And underwriters don't simply just check boxes. And what they do is they're evaluating the overall risk profile of the loan. So, what that includes, they're going to look at your credit score history, your income stability, your employment consistency, the amount of liquid assets you have, your property's quality, and also your loan structure. In other words, underwriting is all about the probability of your success. And the lender's really just asking one question. What is the likelihood that this borrower is going to successfully repay the loan that we make them? And that's why two borrowers with similar income and credit can receive very different outcomes. So let's talk about why mortgage brokers structure loans differently. And this is where mortgage brokers really provide value. And instead of forcing borrowers into a single bank's rules, brokers can structure deals strategically by adjusting a few levers. We can look at the loan program we're using, the amount of down payment we're investing, what are your debt to income thresholds, your reserve requirements, and are there any lender specific overlays or rules? And sometimes the difference between approval and denial is simply choosing a different lender. And with access to hundreds of lending sources, brokers can match borrowers with the guidelines that best fit their financial profile. So let's talk about the strategic approach to mortgage approval. And professional investors and experienced borrowers already understand this concept. And mortgage approval is not just about one number, but it's about the overall big picture loan structure. And smart borrowers will focus on managing their debt to income ratio and keeping that low, but also maintaining liquidity and structuring it with the right loan programs and working with lenders whose guidelines actually match their profile. So when these factors align, approvals become significantly easier. So the final thought for the day is that the mortgage process can feel a little mysterious, and because most lenders really don't explain how the underwriting process actually works. But once you get to understand the real rules, the DTI, the reserves, and the risk analysis, the process becomes much more predictable. And if you want to structure your mortgage the way experienced investors do, working with a broker who understands underwriting strategy can make a significant difference. My name is Bill Rapp. I work for a company called Medallion Funds. My website is billrapponline.com. Love to talk to you more. Please visit the site and schedule a call. And have a good day.